No. No, I flip houses. I flip houses though.
I showed y'all's place out on, is it Wildwood? I tried, but, I mean, it's been a while back.
Hey, I'm good. How are you?
Okay, and what is it on? Okay. Those got better light view?
Good morning, everybody.
Good morning.
Thank you guys for coming out. We're super excited to be here. Super excited to have Miss Susan Eisenhower here present this to us. I know this is a topic that a lot of us struggle with and or just don't know a lot about and want to be able to help teach people and learn about. So I'm Tracy Conley with the Wood Group of Fairway, and I'm our Marketing and Events Director. And then we have Miss Laura Palmer and Lacey Steenson, our loan officers from the Fairway Wood Group. And I hope you guys enjoy the class. Lunch should be here around noon, and I'll turn it over to Miss Susan.
Yep, awesome. Well, thank you very, very much. Tracy worked really hard to coordinate with the board here and get lunch, so I appreciate her hard work and everything. And I'm really glad to meet all of you and see so many. We were just talking about, like, it's July and realtors are busy and it's your busy season, but you took time out for education today. And so I appreciate that. We are really passionate about the information that we are teaching in this Credit 101 class. I've taught it so many different times, and every time, you know, everyone comes away saying, gosh, that's something I can really use and I can help people with this information. Because credit is one of those things that can really open a door or close a door when it comes to building a trusting relationship with a client. And if there's something that's going wrong, you know, it could certainly be an area where you have the opportunity to be a trusted, helping, you know, professional. And so if you've got the right information, it will help you and help your buyers as well. So just a little bit of housekeeping. You should have a packet where you can take notes. There's an outline of the class there. If you don't have one, maybe I think there's some extras we can pass back there. Make sure that you get one. You also have my business card, as well as just a little bit about our company. Need some more extra packets. Are we good? Is it getting warm?
Yeah.
Okay.
It's just no problem.
No, well, hey, it's probably all of us. We're going to be struggling with that. It's pretty bad. So, great. Okay. Just a couple of things. I'll tell you a little bit about our company. Elevate My Scores was founded by Chris Bush. He's been in the credit repair industry for over 10 years, worked in big corporate credit repair, and really wanted to create a better business model that was based on trust and relationships and speed for our clients getting through and getting out on the other side and getting qualified for a home loan. So I don't know if you see the family resemblance, but this is my brother. And so I had the great pleasure of coming in to work in the company about 2 years ago. I'm a former educator, but I've always had a love of business, and certainly the opportunity to get to work in a family business has been really rewarding for both Chris and I. And it's been an opportunity to help grow the company in new ways. So we are on Facebook Live today. That's what the little camera is here. So hello, Facebook land. But it helps get our company out there. So anyone who has ever liked our page gets to see, oh, they're teaching another class today. Oh, wow, look, she's up in Temple, right? And so it pops up in their Facebook feed. So it will help us a lot if you will go to your Facebook and like our page. So that when we have a class or an event, you'll see information about that. I know Tracy's got some raffle items today, but I'm going to raffle off this great mug, and I'm going to take the names of everybody who liked our Facebook page today from the class. So if you want to go, I know you have your phone handy, so go ahead and open up your Facebook and find Elevate My Scores and just like the page. And it'll drop it in a list for me, and then I'll draw before we leave today to give away this mug. But like I said, it'll help you stay in touch with events if you wanted to refer a client or recommend the class to a colleague. If you have a client-related question today that you feel like is really important and you want to, get me to be in touch with you pretty quickly, or something that might be a little bit more, personal, let's take it offline. Go ahead and text me and just say, hey, Susan, can you give me a call or whatever. This is my direct business line. I can call, text, fax, all of that good stuff. So feel free to take a picture of that and save that if something comes up that you want me to contact you quickly about. So, okay. Well, let's just jump in. So why, well, I know our loan officers look at credit reports all day long, and I look at credit reports a lot. So, but you may not look at mortgage credit reports all the time. But why are there 3 scores on a credit report?
3 bureaus.
3 bureaus, yes. And they are called Experian, TransUnion, and Equifax. Okay, yes, it's okay if you talk in the class and answer questions. Good. Okay. So why are those scores so different? Why are they not, exactly the same? What causes the numbers to have some variance in them? Do you have any clues, any ideas?
Different matrices on how they calculate the score.
Different ways of calculating.
Some people like lower credit, some people like higher credit, some people like fill in the blank.
Yes, we call that an algorithm. There are different algorithms that they use for computing the scores, different algebra problems, right, for putting it all together. Each bureau has their different algorithms, okay? But on top of that, there are some other factors that can cause the scores to be different. So different creditors report to different credit bureaus. So you might have a medical collection that's reporting to TransUnion, right? But then you have a credit card that's reporting to all 3. So if you overlay all of those different factors, that can cause some differences in the scores, right? Did they have different information about you, right? We also see that credit cards report to the bureaus on different days of the month. So, for example, you might have a Capital One card and it might report to the one bureau on the 1st, and then it might report to the other 2 bureaus on the 18th, right? Now, we'll get into this. This is back over. We'll get into why this is really important. But on the 1st, your balance might be $900, right? And on the 18th, you might have just made your payment, so now it's $100, right? So the credit score that is computed for you can be very different depending on which day. So if you add that other layer of even that one trade line that could have so much different reporting going on with it. But the big difference is the algorithms. As was mentioned before, the formula that is used for computing the credit score, okay? And in fact, there are over 100 different algorithms used in credit scoring. 100 different ways to get a credit score, right? Okay. Now, I'm sure you've heard of FICO, okay? And we tend to think that FICO is, well, that's the score that I'm looking for, right? That's the one that's going to matter, my FICO score. Anybody know what FICO stands for?
Fair Isaac.
Yes.
Credit.
Close. Fair Isaac Corporation. Yes, Fair Isaac Corporation. And I think this is kind of an interesting little side note. Fair Isaac Corporation was named for 2 Fair Isaac. Mr. Fair and Mr. Isaac. It was named for 2 mathematicians. And they invented the idea of creating a credit score. This was back in the 60s. They wanted to come up with a numerical way to compute your ability to borrow money and pay it back, right? So they looked at all these formulas, and figured out a way to do that. Now, scoring didn't come to the mortgage industry till the 80s. So if you were like my parents when they bought their first home, back in the early 70s, they had to bring their tax returns and their bank statements and their, pay stubs and put them all out on the table. And there was a different way to look at your credit worthiness at that time because there was no credit score, that was used in the mortgage industry. So it was until the 80s until that happened. So now, interesting enough, even in FICO, there are 49 different FICO algorithms. Okay? So we think FICO is that one that we're looking for, but even a FICO score is not really a FICO score, right? So I told you that there are 100 different ways to compute a credit score. So a credit score is kind of a relative thing, but then even within FICO, it can be a relative thing as well. So only 9 out of those 49 FICO algorithms are mortgage algorithms, okay? There are 3 that are primarily used today. They're called Fair Isaac version 2, Classic 04, and Beacon 5.0, okay? And so when you pull a mortgage credit report, whatever their credit reporting service is, you're going to see the names of those algorithms on the credit report, okay? If you go to anybody use MyFICO to look at their credit score? Everyone have been to myfico.com? It's a paid service that they have, and you can pull up a FICO score there, but it's not a mortgage FICO score. So in order to get a mortgage FICO score, you gotta go to a mortgage loan officer, right? And they're gonna pull a mortgage FICO score, okay? And that is how you get that. You can't go to the internet and get a mortgage credit score, okay? But I bring up the internet because that's how people are looking at their credit score today, right? Yeah, right? Credit Karma. Anybody use Credit Karma? Yeah, okay. If you have a credit card, they probably tell you your credit score on a regular basis, maybe in your bill or in the app that you access, right? Your bank might tell you that, Discover Card. Any other ways that you guys are looking at your credit score?
Just pay your bill sometime.
That helps your credit score, yes, it does.
Through your credit card, you see your FICO sometimes.
Yes, through your credit card, for sure, absolutely.
Annualcreditreport.com is what.
A lot of people like to use annualcreditreport.com, yes. Not my favorite, but I'll tell you a little bit more about that. But however you're monitoring your credit, by looking at it on a regular basis, you can see the trend. Is it going up? Is it going down? Are there new things that are reporting on your credit, right? And it gives you the opportunity to stay in check with it. Now, the big thing to know is that if you're looking at your Credit Karma, let's just use that for example. It's probably the most popular one, gets a lot of press, right? You're seeing a score that is not a lending score, right? It is a consumer informational credit score, okay? And it's not anything that can be used in a lending decision, right? FICO scores are lending scores, right? Okay. And as a general rule of thumb, we like to say that Credit Karma score is about 30 or 40 points higher than the mortgage score on average. Not all the time, but loan officers, would you kind of agree with that? Yeah, okay. So if you've got someone that says, hey, Credit Karma says I have a 620, and I heard, you're right, because you got, right? I heard that's what I need. That's what my friend said. I need a 620 for that loan, right? I could get all that, right? So then you can subtract in your head to know that 620 is probably a 580 to 590, right? Right? Which means that they're probably not qualifying yet, right? So, just to have a good understanding of that. And then if your buyer goes to Fairway and they pull credit and it says they're a 585, right? The loan officers didn't ruin their credit by pulling it, right? Because actually one inquiry is only about 3, 4, 5 points in a drop, most of the time. So it's just the difference in the source of the credit score, right? So when you're looking at your credit score, you have to understand the source, okay? So the mortgage industry pulls lower scores across the board, right? And it's because, if you help your buyers understand this, it's because a mortgage score is about your ability to pay back the biggest amount of money you'll probably ever borrow, right? And I found that statement right there, people go, oh, yeah, okay, I get that, right? That's probably the most money I'll ever, borrow in my life. So it's looking at some different things. Yeah, you have a question?
You said probably would drop your mortgage credit score 30 to 40 points. Is there any possibility it could be 30 to 40 points higher?
Okay, we're not talking about a drop. So there are two different things.
Well,
that,
when they calculate it,
right.
but what things would they use differently to calculate it so it comes out lower than the normal things you have in the FICO score?
So, Credit Karma.
And then is that possible to have those parameters higher so you could get a higher score instead of an automatic lower score?
So Credit Karma uses an algorithm called Vantage 3.0. And if you have a Credit Karma account, you can scroll all the way to the bottom and it'll tell you this was computed using the Vantage 3.0 algorithm, okay? And Vantage breaks down the credit score in a very different way and looks at different factors. So, and in a minute, we're going to break down the mortgage FICO algorithm and talk about each piece of it and how it affects your score. So you'll be able to see that. So to back up to your question, I'm not really sure that if there's a way to see, if there's a way to fix Credit Karma so it'll tell you a mortgage credit score. I would say.
No, I just wondered, is it possible to come up with a higher mortgage score when you do a FICO score?
Is it possible to come up with a higher mortgage score when you do a FICO
Because you said
score?
when you go back and look at your mortgage score, it's going to be 585 or whatever when you have a 620. Is it possible to come up with a 630 or 35 when you have a 620?
You have to change the what's reporting on your credit. Yeah, I mean, you have to pay down your credit cards.
But since you're looking at different things, could those things possibly be higher?
I would say, yeah, I mean, you guys want to jump in?
Well, if I'm understanding you correctly, I think there's no way for us to almost maybe manipulate it or for us to maybe turn something into factual data for it to, say, hey, here's.
I guess I need to see what's in the mortgage calculation.
Yeah, absolutely. I think when we unpack that a little bit.
Right here, I believe.
Yeah.
Yeah, when we unpack the mortgage algorithm, you'll see all of the different factors. And really time is what changes your credit score, right? I mean, it's paying down the balances on your credit card, or if you don't have a credit card, opening up a credit card and letting it report. Those are some things that can make quick changes. And we'll talk about the impact of negative items as well, that can also be a factor. So there are some industry differences that overlay the credit score, variance that we see. Obviously, like we said, the mortgage industry, we're going to see the lowest scores. The auto credit scores tend to be a little bit higher. They use a little bit higher range, right? And then there's some other industries where credit is used, obviously credit cards, but then in the insurance industry as well. And they look at some different factors in your credit as they're trying to rate you for insurance policies. So, okay, great. Let's break down the mortgage FICO algorithm. There are 5 sections in the algebra problem, right, that are used to compute your credit score, okay? And we're going to talk about each one. The highest percentage out of this is 35%. That is your payment history, okay? So 35% of your mortgage FICO credit score is based on your payment history. This is the payment history of everything that is open and active. All of your credit cards and installment loans, everything that you're currently making payments on. Your mortgage, your auto loan, your credit cards, your student loan, your boat loan, any of those things are all calculated in this section, okay? Now, what helps grow your credit score here is what we call months of review. So the more months that you pay on something, the more it's going to help you improve your credit score, right? So that student loan that you've been paying on for 9.5 years, right, you're going to be so glad when you finally get it paid off. But by making those regular monthly payments on that, you have really helped to grow your credit score, okay? Yes?
Do you have a form, or do you have, is it possible to get a sheet like that breaks down what you just read, what's written there on the board, explains month's reviews and part of it?
It's here.
It's in your,
It's in your
It is?
packet, yeah.
so, is that not the?
Yeah.
I mean, I do,
It may not look exactly like the slide, but,
yeah.
yeah. Try to jot down some questions too, so. So the more regular timely payments that you make on an item, the more it's going to help that particular trade line grow your credit score, okay? So this can also explain then why, has anybody ever experienced, like you finally pay off your last truck payment and woohoo, I'm so glad, right? And then the next month your credit score goes down. Has anybody experienced that? I see a nod back there. Okay, so this explains that. So what happened when you made that last, auto loan payment is that account isn't open and active any longer, right? So it's not helping you to grow your credit score in this section. So it's still on your credit report and it's still a part of the history, but it's not a part of this 35% any longer. So your months of review and all of that is affected. Now, the other thing that is in this 35% section are all of the negative things that are on your credit report, okay? So all of the late payments and collections, charge-offs, bankruptcies, anything negative is calculated in this 35% section, okay? So that's an important thing to note here, okay? So that little tidbit about paying your car loan and having it drop off, that's why you often hear that advice, like from loan officers. Okay, you've been pre-approved. Don't pay anything off. Don't buy anything, right? Just keep making your regular monthly payments, and then and that's why, because that could really affect your credit score. Okay, that could be the longest open account that you have, right? So it could definitely affect that. We get a lot of questions about, well, I heard that it was bad or good to close accounts, and certainly that could be a factor in this thing too. Like Chase really made me mad, and I've got this new credit card and it's shiny and I like this one better, and they've got a better interest rate or they've got a better rewards program, so I'm going to close that Chase card. But if you've had it for 10 years and you've used it all that time, it could have really helped you to grow your credit score. So by closing it and opening a new one, you could really hurt yourself in this section and other sections as well. Any questions about payment history? I'm going to go on. So this section right here usually gets a lot of discussion. So this 30% section right here is all about credit card utilization, okay? So 30% of your credit score is all having to do with credit cards, okay? So there's nothing about this that has to do with installment loans. Do you understand kind of the difference between revolving credit cards and installment loans? Okay, so good. No, that's fine. That's why you want to talk about this. So a revolving account is like a credit card, right? You can spend it up and pay it down, spend it up and pay it down, kind of like the revolving door at the hotel, right? Money goes in and money goes out. And as long as you're keeping up with the agreement as you have promised, you can keep doing that, right? An installment loan, you borrow a chunk of money to buy a vehicle, to go to college, whatever, and then you gradually pay it off over time. You can't get it halfway paid off and then say, ooh, I'd like some new rims, right? Let's go get some new rims for my truck, right? And borrow back against that same line of credit. You can only keep making that those installments until it's complete, right? That's the difference, okay? So this is strictly revolving only in this 30% section. So here's the big piece of the pie to understand here. If you have no open active credit cards, you could just like cover up that little piece of the pie right there, right? 30%. So if you don't have any credit cards, you could subtract 30% of 850, right? That means about the highest credit score you could get would be right around a 500, 550 maybe, right? So it's very powerful, okay? So, and I always say here that, you know, your credit score reflects your ability to use credit, right? Not necessarily about, you know, it doesn't necessarily indicate about how much you owe, right? That's a little bit different factor in getting qualified. But you've got to have a credit card in order to score in this section, okay? And I think people, especially first-time buyers, are a little scared of having a credit card. Maybe they've heard, you know, people, or maybe their family has not been very responsible. They didn't, you know, kind of grow up learning how to use credit. So that's an important thing here. So then the factor that kind of sways this up and down in this is utilization. So that's how much you use the card, okay? So the higher the utilization, the less points you get, okay? The lower the utilization, the more points you get, right? So if you have a $1,000 credit card and you've got a $900 balance on it, your utilization is 90%, right? Okay. So that means you're only about 10% of that is what you're going to get towards your points, right? So if you want to have that account give you some more points back to your credit score, you can pay it down to about $200. Now your utilization is right around 20%. And that's kind of the sweet spot, right? Where you're going to get the most points back, right? So now you're going to get a lot of points back towards your score.
What
Just by changing.
What if you paid it off every month?
That's a good point. Okay, so if you pay it to 0 every month, you know, you're showing a lot of activity, so it's helping you in that 35% section. But you're kind of playing the reporting game. You don't know exactly what day of the month the credit card is going to report to the bureaus. Are they going to report a $1,000 balance or a 0 balance? So there's a little quirk in the algorithm where at 0 you don't get quite as many points as if you had like $10 on it. So a lot of the loan officers that I've talked to say, you know, just leave $10 on it, leave $5 on it, and you'll get maybe a little bit more points than if you leave it at 0.
I've always been doing the auto pay, so they tell the date what's going to happen. I like the points and stuff they're going to give me for doing it.
Right.
And so I buy a lot of big things with the credit cards. And it's like, let's say I'm in a country, foreign country, and I want to buy a diamond ring. Maybe it's $50,000, $100,000. I buy that stuff. Now, what is that going to do with my group?
It depends on when it's reporting.
See?
It depends on when it's reporting. Right. And when you're making your payment. So it's reporting a snapshot on a given day of what your balance is and what payments have been made. So that's why I say you're kind of replaying this reporting game unless you know exactly what day they're reporting, you know. But this is an opportunity for loan officers where they get a file and let's say, you know, their scores are pretty close to a different category of pricing or qualifying or not qualifying. And they could coach the client to say, hey, let's take these credit cards and pay it from A to B, right? And if you get it down to here, your score will go up 42 points or 37 points, right? And that might be what they need to get into that next, right? And you guys probably do that a lot, right? And that's just a little bit of coaching on that utilization, right? And that can certainly help. But it's funny, those simulators will not tell them to pay it down to 0 though, right? They'll say like
Never do.
$11
Well, there's
or
always
something,
something else coming in,
Yeah.
say it
Yeah.
works perfect, you know,
Yeah.
that's the reason I was double questioning.
Right, right. And it's funny, you know, you feel kind of silly because like you're showing lots of responsibility, not carrying a balance, right? Like I said, I think it's just a quirk in the algorithm. But helping your clients understand that if they don't have a credit card, they lose all of this, that's a big deal right there. Yes?
Is it better if you have a card that's open but you're not really, it's not active, is it better to cancel it and not have it reporting rather than having it have lower utilization and getting less points?
So lower utilization is more points, okay? But in order to have it pop up on your credit report, you need to have some activity every couple of months. So here's a good story about this. We had a client that was first-time home buyer, and he was on his parents' BP gas card. But the parents, he was an authorized user, and the parents had had it since the 70s or so, right? But they never used it, and the card was open, but BP never closed it, right? So he wasn't getting any benefit of being the authorized user on this, 30-something-year-old credit card, right? So we asked him, hey, could you talk your parents into going out and buying a tank of gas on that credit card? They're like, no, they don't like to use it. They just like to have it just in case. Well, okay, maybe go buy him a steak dinner or something, to talk him into doing that. And that's exactly what happened. So he was able to, talk to his parents, and they went out and bought a tank of gas on that BP gas card. Now that 30-year-old credit card, popped into the active part of his credit score, and got a great big, jump in that, right? So I would say that if you have some credit cards that you just, kind of gone dormant, to use it every few months to buy a gift, or if it's a tank of gas or something, could help get you some points back. But I don't want to talk about these things in a way to make you worried about, that you're doing something bad to hurt your credit score, But if you're in a point where you're trying to get from, this goal to that goal, and, get a better rate on a loan, or, then maybe all those points matter. And these are some things you can do to help, raise your score. So certainly don't want to make you think like, oh, I didn't do something right.
I don't like the idea of canceling on them. I would rather that the company, some of them, if you don't use it, they'll close it.
Yes,
Let them
they do.
close it, but don't cancel it.
Right, and it will say on the credit report, closed due to inactivity. Or if you chose to close it, it'll say that. But however it was closed, it will notate that on the credit report too. So, okay, now let's talk about the next section, 15%, is length of history. So this is just a straight up average of all of your open and active trade lines, okay? The way to maximize this is to have 25 years of average credit history, okay? So this kind of explains why some of the really super high 800 plus credit scores that are out there are from people that have a mortgage that they paid on for 25 years. That they have a credit card that they've had open since the 70s or 80s, right? That's how you get that length of history here that helps to really grow your credit, okay? And this is where closing a card can also really hurt you too, okay? But if you've opened up a lot of new cards, it might actually help you. So this is an opportunity where if we're trying to help someone with their score, and let's say they opened up a lot of new store cards or something, right? They got a Home Depot card and a Lowe's card, and they have some new credit, right? Well, that new credit might be lowering their average in this section. So maybe in that case, closing some cards would be helpful. So it just depends. You've got to look at the average credit history here. Okay. So we talked about authorized user. You guys familiar with what that means?
Yes.
Yes. Some people are saying yes, some people are going not sure. Okay. So when you're an authorized user, someone grants you the right to use a credit card account, okay? So that trade line, whatever it is, now reports onto the user's credit card, or credit report, excuse me, right? So, and it's just that account. It's not all of their credit report, but that account information is now duplicated on the authorized user's credit report, okay? So all of the information, good and bad, right?
Yeah.
So you want to be careful that if you're thinking about this or going to help someone, that it's an account that's been open for a while. It has a good utilization ratio, right? That's kind of low. It's never had any late payments, that kind of thing, and it could be an opportunity to help someone, okay? Parents very often do this for their kids.
What if you're a married couple and the husband takes, he does all the credit card on his account, and something happens to him, are you gonna have to prove yourself if you haven't used your account as a wife?
So if you're the authorized user on it or not?
She had credit, for example, cards when they married.
Uh-huh.
And I had credit cards when I married. But then we've had joint credit cards.
Right.
So what's the best way to go?
Some of them, just like you mentioned, the Discover. Well, Discover wouldn't bump my values up like I wanted, so I took out another one. Well, then they seen I was doing good, they wanted to give me more, but I've set them back, some, both of them, and using these others. But she's wondering, what's this done her? But
So
she's
there's a
just joint
difference,
them.
right, there's a difference between joint users and authorized users, okay? So joint users means both persons' credit and income are used to qualify for that account, okay?
Yeah.
An authorized user is just someone that you add on, but
Here's
they are
my
not,
child, here's my child.
but they are not responsible for the debt,
Right.
okay, right? They have the ability to use the credit card account, but they're not responsible for the debt, okay? So that's the difference in how that is legally, how that works.
Well,
But going back to the point where parents often do this for their kids, it's a good way to help kind of give a credit score to a young person, and so that if they're going out to, rent an apartment or get utilities in their name, get their first cell phone or whatever, they actually have a little bit of a credit score. Now, you don't have to give them the card. Some parents can decide one way or the other whether to actually let them have a physical card, but it doesn't matter. They can still get that. Now, I talk about authorized users because there are some mortgage companies and their programs or bank mortgage loan officers at banks that are a little bit particular about authorized users on a mortgage credit report. I don't know a little bit about how that works with that Fairway, but there are some situations where they have to look at that with the DTI and if that person is on the loan or not. So you always want to recommend that carefully. It certainly could be something that you use temporarily to help someone get what they need in order to get their own credit, but it can be important. So if you have a real thin credit file, let's say you just got 2 or 3 items that are on your credit report, adding a new account could really affect your length of history. So that's why it's good to have a few things on your credit report. 1 credit card is good, 2 is better, 3 is probably best. So that if you did have to take out a new signature loan or a new credit card, you're not affecting the average here as much as if you only had 1. So if you only have 1 credit card and you open up a new account, now your average is cut in half, right? Because you added, now you have 2 accounts and your length of history is still the same. So having a few accounts in the mix here can help you if you did need to open the credit. Okay, 10% of your credit score is types of credit. Okay, and like I mentioned, it's a good mixture to have 3 credit card accounts for every installment loan. Now, that doesn't mean that if you have 6 credit cards that you need to go out and get, 2 installment loans. I'm not telling you that, but that's just a good ratio, okay? How to maximize that, okay? Your score can be affected by having too many of certain types of accounts, okay? You can have too many store accounts on your credit report, and that could put a reason code at the top. In fact, we saw a credit report from one of our clients that came to us, and that was the reason code at the top. Too many open store accounts. As we started looking through the credit report, we counted, and this client had 25 open active store accounts. Yes. She was a shopper. Now, she was using them and making payments on them, and they were not late. They were, in good standing, but it was too much, right? Turns out she lived in Dallas by the Galleria. Who knew? But obviously she was like trying to get the best deals and the % off and the frequent flyer, whatever, kind of shopper type thing. So we worked with this client because we wanted to get that reason code off of there because it was hurting her in this section. But also at the same time, we didn't want to close down her oldest accounts, right? Because that would hurt her length of history. So we strategically, did the math and tried to figure out which ones we could leave open that would be, help her credit to grow in all of those sections, but then also, help this reason code come off of her credit report, and that's what we did. So you can also have a reason code here that says too many financial accounts. So a financial account can be like a signature loan, a payday loan, a speedy cash kind of a loan, Sun Loan, Rise, One Main Financial, those types of super high interest, float loans, right? And even if they're paid as agreed on time and no late payments or anything like that, if you have a series of those, and a lot of people that get started doing those, do them again and again and again and again, right? And I often believe that those are marketed as something that is supposed to help you with your credit, right? But if you're looking at a credit report and you just see that this person is every quarter, they're going down and getting a new, $500 payday loan, right? What does it look like if you're the underwriter looking at that credit report?
Sad story.
A sad story. But it looks like they can't live within their means, right? And that is a red flag that jumps out there. So those types of loans can actually really be derogatory in the long run if they're in a series like that, and they very often are. So that's just kind of one of those things. We had a teacher one time, a single mom teacher, and she was in the habit of doing that because she just, wanted some things for her kids. We want some toys, we want, and we're like, hey, okay, but this is, we've got to figure out how to get you out of this cycle and help her to realize that, that was actually hurting her and not helping her. And the last part of the pie here is new credit, okay? So, and this is a part of your credit score because the highest rate of default happens in the first 90 days of opening an account, okay? So that's why your credit is affected every time you open a new account. So you're going to see a score drop as a result of this section every time you open a new account. Now you'll start to get that back over time after you kind of reach that 90-day point and you're, completing your agreement, right? Okay. Another part of this 10% here is inquiries, okay? And that's when you're checking your credit. There are two types of inquiries. There are hard and soft, okay? So a hard inquiry is where you're applying for money or credit, okay? So, and a hard inquiry is going to affect your credit score anywhere from 3 to 5 points per hard inquiry, okay? A soft inquiry doesn't have any effect on your credit score, okay? It's where you're, like if you're checking at Credit Karma or like a background check that is a soft inquiry, or credit line increase review is often a soft inquiry, right? And it doesn't have any effect on your score. You're just getting information, okay? So let's talk a little bit about shopping windows. Anybody familiar with what with that kind of concept is?
Well, like for the mortgage, like don't you have 30 days to shop for a mortgage loan, and they're all considered one inquiry, right, or multiple?
One. Right. So is that kind of the 30 days is what you guys hear to? Okay.
Is that just for mortgages?
It's for autos, for auto loans and student loans as well. If you go to the CFPB website and look up their guidelines about that. So technically, it's to protect a consumer, theoretically, so that they can shop around for the best fit for their mortgage or their student loan or their auto loan. Okay, and generally in the mortgage industry, it is very standardized. You can get different mortgage pools within a period of time, and it's going to condense into one. Okay, but let's be careful about the auto industry. And I don't want to sound like I'm bashing the finance guys at the car dealership, but when they are running inquiries, they tend to do a blast and cast. If you go there and you're going to buy a car, and they're going to send your information out to try to get you the best rate. And some of those are applying you to auto financing, like Ford Motor Credit or Capital One Auto Finance, right? But some of them are also other types of institutions that do other kinds of lending. So it might be coded as financial, and there are no shopping windows in the financial industry according to CFPB. So to illustrate this, you probably have seen this too. We had a loan officer that called us and said, hey, my client bought one vehicle at one dealership and his score dropped 35 points. And the new trade line for that loan is not even reporting. What happened? Well, we kind of knew probably what happened, but we looked at the details and looked at the inquiries at the bottom. There were 14 inquiries, okay? 4 of them said auto, 10 of them said financial. So he was seeing the effect of 11 inquiries because the 4 condensed to 1 and then plus the other 10. 35 points, right? I'm going to do the math, 3 to 5 points, right? Right. Now, is that wrong? Well, I don't think that was the intent of what this guy tried to do when he went to the dealership, right? So, just kind of buyer beware. If you are at all able to maybe get your financing from your credit union or wherever you bank, beforehand, and take that to the dealership, or just work with someone that that's like, hey, don't try to send it out to 10, 15 different places. Just do that one, right?
You know what I'm saying? If it ain't broke, don't fix it.
Yes, ma'am. I do know what I'm saying.
Do you have to dispute each one of those?
You can, yes, you can go through a process to dispute using the Fair Credit Reporting Act.
And they lump all of, like, they said there were 10 finance or whatever.
Well, I did actually work with that client and got those other inquiries removed, yeah, so that could get his points back, but.
So let me ask you a question. How long typically would your score increase if you did?
Very good question.
If you did not dispute?
If you did not, well, so if you, right, so good point. Inquiries stay on the report list for 2 years, okay? Now, loan officers at mortgage companies usually only see the last 120 days because they're looking for things that maybe that you've applied for but haven't shown up on the credit report yet, so that's why. But the impact of a hard inquiry lasts about 6 months. And then, so that's where we're seeing the most impact. But there's actually a little trickle of an impact that can go on for a year in your score. But the greatest impact is that first 90 days. Yeah.
So you said you've helped somebody, because I've seen that before in running someone's credit, where just a month prior they were trying to purchase a car and there were 15 different hits on their credit, and then it showed under each, Experian, Equifax, TransUnion, each of them showed the credit score was impacted because of too many inquiries. So you said that you helped, if you get that off, how long does it normally take, turnaround time for that to impact the score? To get it off?
So per the Fair Credit Reporting Act, they have 30 to 45 days to respond to a letter of investigation. So that's just kind of the process that we go through. You know, it's not a quick fix. But it depends on the timing of that client, you know. Maybe there's ways to help their score, you know, with some other quicker fixes like utilization or whatever.
Yeah.
But
So if we're not seeing it, it still could be impacting the score because we're only seeing the 120 days. Because I was thinking that it was really just kind of impacted their score for the 120 because that's all we see. But really, it can impact the score for up to 6 months.
and even up to a year, yeah.
Yeah, it's painful.
But the reason, yeah, it is, for sure, yeah. We use a credit monitoring service that we really like called Identity IQ. And it pulls up a credit report and it does show the last 2 years of all those inquiries. So we can see what, you know, how we could help, you know, work with the score in that way. But I think that the reason why mortgage credit reports only have the last 120 days is like, I think because you're looking for things that they've applied for that
sense.
might pop on and change the DTI, right? You know,
Yeah.
so, yeah. Okay, good. All right. So this breaks down the whole mortgage algorithm and talks about the impact of all those sections. It's a good stopping point for us to kind of get up, take a bio break and stretch. I think lunch from Chick-fil-A is coming soon. Yay. So let's plan to take about 15 minutes. I bet hopefully Tracy's outside with some chicken. And and we'll get started in about 15 minutes or so and come back. And then the second half of the class, we're going to talk about negative items, collections, about how to build credit, and then we'll let our loan officers talk to you a little bit about updates, what's going on with Fairway, and how they can help you in your business. So, awesome. All right.
The other one's better.
There's different groups under Fairway. So there's 2 different groups.
Yeah, I've done business with Blair, he's just business.
We have our boxes have like
Nice to meet you. Well, mine's been kind of slow. Always. Young client can take.
You gotta buy them. Always. You have to buy them. Because you don't ever know what you're coming into when you start with.
Well, yes.
Yeah, it does.
So we've been lucky, in this marketplace, rates and increase, right? So, but yes, you always have to buy them right.
So
And when you do, when you get this bonus, that you have in the market, it'll go wrong too. Here's an example of one that could have gone. Belton is
Business
the one.
services fee is a lot. So if I were to drive up in
And
the afternoon and
bought
drive
it
the
at
deal,
65,000, it was a 2-bedroom on that.
that's a bonus, yeah.
It's like 400.
midnight on Saturday.
And
Yep.
Real fast, I just wanted to pop in. I'm Amber with First Committee Title. We brought you lunch. Thanks, Tracy gave us a call, and I was happy to bring in some lunch. So just wanted to pop in and say hi, and glad y'all are getting this education. If we can help with anything, definitely let us know.
Thank you. Yay, lunch, lunch, lunch. Very good. Okay. So we're kind of on the downhill side of the class and the content, but there's still some really good information here. So continue to eat and finish up, but we're going to pick up the class and talk about building credit, okay? So you learn that 30% of your score is that, utilization for credit cards, but you kind of get in this thought of, well, if I don't have a really good score, how am I going to get a credit card, right? So you might have heard about secured credit cards. Those are one way that you can help to establish some credit and then kind of step to the next level of unsecured credit. So let me tell you a little bit about secured credit card. It means that you're putting down a security deposit, and then you usually get a line of credit on a credit card equal to the amount of the security deposit, okay? A lot of secured credit cards do actually pull credit. If you go to down to your bank and they have a secured credit card program, they're going to pull credit. So I want to recommend one to you that doesn't pull credit. It's called Open Sky Visa. There's our website openskycc.com. So if you go there, and we found them on creditcards.com website is where we found them. But so Open Sky Visa does not pull credit. You only need a job and a bank account in order to get an Open Sky Visa. You'll make a minimum $200 security deposit with them. And one of the reasons we feel good recommending them is because there's no hard inquiry, right? So you're not getting a hard pull on your credit. They also report to all 3 credit bureaus. There are some secured credit cards that only report to 2 out of the 3. So we like this so that if you're going to get an increase, you're going to see it across all 3 scores, right? They also have a pretty fair annual fee of $35 and an interest rate around 18 or 19. But there are some unsecured cards that have higher interest rates than that. So for someone that's just starting out and you don't want to put them in a 39% interest rate credit card, this is a little bit better way to get started, okay? We often recommend this as a beginning for someone who has no credit cards, and then after they get their scores up right around 600, they can qualify for another type of secured card that pulls credit. Like Capital One is a pretty good one. Capital One secured card, if you can qualify for them, then after a year of on-time payments, they'll graduate you into an unsecured card, so that you'll get a refund of that security deposit. Did you have a question?
Yeah, I was going to ask, what is the annual fee that they charge for that service?
So Open Skies is $35.
And then the next question I had, just to kind of answer that, some of them graduate them out of the secured into unsecured, or when is a good time for a secured person to know that they can go and get unsecured?
It's all going to be based on your score. That's one of the advantages to Credit Karma, because they do have built into their app types of cards you could qualify for. So if you are using something like that, like Credit Karma, and let's say you get an Open Sky Visa and your score gets to be about 610 or 620 on their app, you could probably qualify, but they might actually show you types of cards that you could qualify for. Capital One is gets a lot of press, but they're probably one of the better ones to get started off with before you can go into a Chase or Citibank or something like that. Yes.
And do they report more often, or no? Is that not? For some reason, I was thinking some of the other credit cards may not report every month, but that secured credit cards do report every month. I could have just randomly made that up in my head. It's totally possible.
I think they do report monthly. It just, it may not be to each bureau on the same day, right?
Okay.
It just depends, but, Open Sky reports, you know, pretty quickly after you fund it and like go out and buy a tank of gas is what we say, you know. And if you're using it to build credit, you don't want to get that $200 credit card and then go out and take everyone out for drinks, right? You know, do something small like a tank of gas, or use it for your Netflix or something, you know, just a little bit of a charge. Some activity where you're going to have some regular charges and then make regular payments. And after a few months, you're going to really see a good boost in credit. Installment loans are definitely, like we talked about, a way to grow your credit score. Those regular payments over time that you use with an installment loan can really help to grow your credit, okay? Another way to help build credit and put some activity is with rental reporting. And I know that's kind of a wonky website right there. Sorry for that. It's not really easy to remember. But we use a company called Rock the Score. And they will report rental history with a rental agreement at an apartment complex or through a property manager to Equifax and TransUnion, okay? So for a small, like $8 or $9 monthly fee, you can report your monthly rent as a self-reported installment account on your credit. So for someone who doesn't have a lot of credit history, it could be a big thing, okay? You can't just report, you know, like if you're paying rent to Uncle Joe, you know, and you don't really have an agreement, that doesn't work. So it needs to be somewhere where there's a verifiable agreement that they can report. Rock the Score also, if you pay, there's an upgraded fee, or they'll go back and look at the last 2 years of rental history. So if there's someone who really wants to like move fast and get some open active accounts, that would be a way to do that. You guys ever heard about Experian Boost?
Can you repeat that?
Experian Boost? It had some commercials about it, and I'm a little hesitant to recommend it, but so Experian has come up with their own self-reporting platform where you can report utility payments onto your credit report, and it's free, okay? So basically you go to the Experian website and you find Experian Boost, and then you give them permission to do a metadata scan of your bank account. They're just looking for regular utility payments, okay? And then they report that as an open active account on your credit report, okay? So, but it's only to your Experian report, okay? Some of the loan officers we've heard have had mixed reviews, like there have been a few that said, oh, we actually had to get that removed because it hurt some other things in the underwriting. So I wouldn't say that it's a hard and fast, you know, thumbs up, but for someone who maybe their goal is not, you know, to get into a new mortgage, maybe they just want to build their credit so they can go do the next thing, it might be something to look at. So just, if you Google Experian Boost, you'll find it. Okay.
In building credit, one thing I've done in the past, sometimes it don't work, but it's up to the individual to go to a bank, tell him he wants to open an account, tell him that he's trying to build his credit. And sir, I would like to borrow $10,000. I want to put it in a CD, attached. I want to pay you the interest on it because I'm trying to build my credit. 6 months, he's got a loan paid off $10,000. He's got credit history where he's had some money. It works sometimes.
You got to be able to qualify for that too, though. So yeah.
Well, it's never going to leave the bank, and the banker's making money.
Right.
It's in the bank, guaranteed by the bank.
So let's talk a little bit about identity theft and errors. So one of the reasons it's so important to look at your credit on a regular basis is because there are things on there that don't belong to you, right? Now, we get really upset and, feel violated by theft-related things. When our card gets compromised, we get really frustrated about that. But in actuality, reporting errors are way more common than theft-related things that are on your credit report, which is why it's important to check your credit on a regular basis. So there are some good credit monitoring programs out there. We like Identity IQ as an example, but there are some other ones that are comparable. If you go to our website, elevatemyscores.com, and click on Check Your Credit, you can get a link for $10 off with Identity IQ. It brings their monthly fee from $29 down to $19. But it's a full 3-bureau credit report. And that's one thing about Credit Karma. It's only 2 bureaus. You don't always see all of the payment history. So Identity IQ, you get account numbers, phone numbers, addresses for everybody. You'll see all your inquiries for the last 2 years. It's a very comprehensive report. So that's just the example of one of those types of credit monitoring that's out there. LifeLock is another one that's really popular you hear about. These are the types of theft-related things that could have an impact, certainly on your finances and in some cases on your credit. Mail theft and dumpster diving, that's pretty self-explanatory, right? Somebody steals something from your mailbox. In today's world of locked mailboxes, that may not be that much of a big deal, but I know in my neighborhood, my mailbox is at the end of the driveway, right? So that could be an issue, right? Where if you get a new card mailed to you, someone could swipe it, right? Dumpster diving is where somebody's fishing through trash trying to find sensitive information that they could use, right? Pre-texting is a really interesting topic. That's not something you do before you send a text message. Pre-texting is using some information that you can verify to gain additional, more sensitive information. So a lot of senior fraud, telephone fraud fits into that category, like the phone call like, hey grandma, this is your grandson and I'm in jail and I need bail money. You ever heard on the news a report like that? My mother got a phone call very much like that, and she called me right away, panicked, where's Robbie? Oh my gosh, is he okay? I think he's at school, Mom. What's going on? But the person, was trying to say, oh grandma, it's me, right? To fish and get her to give, that information. Sometimes it could be an alumni association calling, like this is the A&M club, and because I know you're an A&M alum, I know you'd love to give to this, let's have your credit card, right? So there are any type of a contact like that. The Microsoft phone call, right? Anybody gotten one of those where Microsoft is calling to tell you that your computer is compromised? Or I got one that said they were Apple support and that one of my iTunes accounts had been hacked, right? But they couldn't tell me which account because there are, probably about 5 different iTunes accounts at my house. They couldn't tell me which one it was. So I knew it was, it was that type of a phone call, right? Shoulder surfing is being concerned about keeping your PIN private while you're typing it in. Because someone that sees you type your PIN could then steal your card and have both card and PIN, right? Phishing is where you get a message that says, like from Wells Fargo, whatever you've gotten one of those text messages before, that says we need you to verify your account information, please click here. And I got one recently, but I don't have a Wells Fargo account, so I knew that it was phishing. But they just, sent out a blast like that to some numbers that they got, to see what they could come up with, right? That's what phishing means there, right? Skimmers have been getting a lot of press lately. Skimmers are a device on a gas pump that skims your magnetic stripe information and then gets your PIN. They're Bluetooth device that was fraudulently put onto the gas pump. You guys have heard of that before? Yes, okay. Right.
Try to pull them off. They're very easy to get off. Then you know it. You can get it off. That's what it was.
Yeah. supposedly you're supposed to look for a seal that's been broken, and if the seal has been broken, then you can tell possibly it's been compromised, so. Breaches are something that we've heard about. Did y'all hear the news today, that Equifax settlement? So if you think if your information was in that Equifax breach a couple of years ago, there's now a class action lawsuit that's being in the press, so read up about it. But that's where a merchant account gets hacked. Target had been, a victim of that. I think Home Depot for a while their account was getting compromised in those breaches. So ransomware is like a virus or a malware that goes on your device to lock it down so you can't use it, and it demands a ransom. I had a realtor in a class one time that said that his laptop had been hacked with ransomware, and he just took it to the IT guys like the Best Buy or whatever, and was just praying that they could get it off. But yeah, that's a thing. Wire fraud has gotten a lot of press lately, and rightly so. You guys kind of heard a little bit about what's happened in Austin recently, where there were title company funds that were diverted away from a title company with a message that said, please wire money here. There wasn't clear communication about how to and who to speak to and how to make that happen. So the fraud, happened as a way somebody got in and diverted those funds.
It's usually right at the end of the deal too, because we have those phishing things going on regularly.
Yeah.
And if you let go of the money, you may not get it back.
This one gentleman did get, $300,000 or so back, but boy, that sure was a long process. Yeah, for sure.
I had some clients that were in Haiti, and I'm thinking that it's the title company's email that keeps getting attacked, because people actually emailed the clients directly after the title agent and emailed the clients and said, ignore what she said, we're having some issues with our system, here's the correct. And they named the real estate agent, they named the title company, they named the other escrow officer that they were working with. They had everybody's name, they've been following the emails. And thank goodness he called me immediately. It's like, this sounds funny. Yeah. So we kind of played around with them and went back and forth with the people for a while and contacted the FBI. But yeah, they're so smart. I always tell people, double call. You look up the phone number to the title company and you call the title company after. It's so smart for agents.
Absolutely. Yeah.
Never trust anything that's sent to you, even if you know the escrow officer, you still find the number, call, verify the phone.
Yeah.
That happens, and a lot of times when the money's gone, it's gone. There's nothing that can be done. And we've seen it fairly happen.
Oh, that's so sad. Think about somebody that's all of their equity was in that home, and then like that one guy in Austin. Whew, if you go to the KXAN Austin NBC affiliate, their website, there's a news report about how the guy got his money back and everything. So really interesting. But like I said, we get really upset about all this theft and compromise of our accounts and that type of thing, but errors are way more common than theft. So let's talk about the types of errors that can be on your credit report, okay? If you have a common last name and live in a highly populated zip code, you probably have some cross-reporting, right? Like John Thompson that lives in 78681 in Round Rock, like something like that, right? A really common name, you could have some cross-reporting, okay? Smith, Jones, Lopez, Martinez, that kind of thing, right? Okay? So that could cause some incorrect information to pop on your credit report. Juniors and seniors have a lot of cross-reporting that happens because they have essentially the same name and have lived at the same address, right, for a period of time. We've seen it with family members that have same first and last name but different middle names too, right? So, because like I said, because they were at the same address. So that can cause some cross-reporting. And here's an odd one. This is an error that actually causes files to merge, okay? So if you have 4 letters of your name that match with 7 out of 9 social security digits, the files will actually completely merge together, okay? And this is why now when social security numbers and families are issued, they don't do consecutive numbers, right? It used to be that, you know, if a parent went down and applied for their 2 children to get a social security number, they would be 1 digit off, right? And they would just get the next. So now they don't do that because of this right here. They make sure they're pretty different. But we found a good example of this. We had a client named Roberto. He came to us and he said, this Chase account right here, this is identity theft. Someone's stolen my identity. I've never had a Chase credit card. You need to fix this, right? Okay. So we started looking at that trade line. Well, the account belonged to someone named Robert, not Roberto. The Chase card had been, monthly payments had been made on time for the last couple of years, right? It was the most honest identity thief ever, probably, right? But it really wasn't identity theft. That account belonged to Robert, and 8 out of the 9 social security digits actually matched. So their files merged completely. And poor Robert probably had some negative things from Roberto that were showing up on his credit report too. Maybe he just hadn't checked it, right? So that can actually happen. Poor Roberto, though, that Chase card was one of his better trade lines. So we actually left it there for a little bit until he closed on his home loan, and then we got it removed for him. But that can happen. And it'll say Social Security mismatch on the credit report is where you'll see that. So now let's talk about the types of negative items that can be on a credit report. There's just kind of a big laundry list here, right? Collections, bankruptcy items, those are accounts that have been through the bankruptcy, come out on the other side, right? Charge-offs, profit and losses, inquiries, like we talked about, tax liens, judgments, medical, divorce-related issues, like, you know, we bought this car together and, you know, after the divorce, he stopped making the payments, that kind of thing, right? Identity fraud, foreclosures, we should probably put short sales in there because they're actually a little bit different in how they definitely still negative, but affect you a little bit longer, right? Repossessions and any and all late payments. Boy, we've just seen a lot of credit reports with repossessions on them lately, and people that think that when they give the car back to the bank that it's done, right? So what happens is the bank sells the car, recoups their losses, and they're still going to collect from the original creditor. So now, right, that poor person doesn't have a car and they have a $15,000 repo on their credit report. It's just so devastating. So, yeah, that could really be a huge factor, right? And of course, all those late payments that you would have would add up and be negative items. Now, this is where we in credit repair can roll up our sleeves and get to work using the Fair Credit Reporting Act as a legal process of investigating negative items on your credit report, right? This is how we can help people get these types of things removed, okay? Some cases we also actually use the Fair Debt Collection Practices Act, and this is where we send letters directly to the creditors and get some faster results in that way too. But these are the types of things that can help get removed in credit repair. Now let's talk a little bit about collections, because collections are kind of hard to understand their impact, and different types of collections have different type of impact, right? So you can have medical collections. We see in today's world of insurance and the way things are billed, people are getting more and more medical collections, okay? Student loan collections can have a really different impact for sure, and a really long-lasting one in terms of credit and the ability to borrow money again. Utility collections, rent collections, and certainly credit card collections. So let's kind of unpack that a little bit. Now, if you have medical collections, the good thing is that loan officers aren't going to be necessarily worried about the amount of those medical collections in your ratio. Report that shows any government-backed loans that are in default, right? And it would affect your ability to get another government-backed loan, right? Like an FHA or USDA, right? So really important. So if we see a client come to us they've got student loans where they've got late payments or collections or possibly default, that's priority one, right? Is getting those out of that state. Usually a really honest phone call with the Department of Education is kind of how you start the process. You can get into an income-based repayment plan, and usually after a period of time of making those on-time monthly payments, they'll go back and re-age the account. You can consolidate. There are lots of ways that they can work with you, but big, point of advice there. If someone's got student loans and collections, that they really have to be addressed because it is a longer bit process to get it back on track. Okay. So, how many of you think that if you pay a collection, it's going to help your credit score? Why not?
Why not?
Okay, good question. So, a collection affects your credit the most when it has a new date of activity. So a brand new collection is going to affect your score the most. And then as that date of last activity gets older and older and older, the impact of it on your score decreases. So what happens when you make a payment on a collection that has kind of an old date of last activity, you restart the clock. And so now it's affecting your credit as if it were a new collection. It renews the date of last activity. So, sad story, we had a client that was single parent and she had been pre-qualified and kind of been through our program and everything was looking good that she was going to get into this home. She got a call from a medical collection company and they said, and they did not tell the truth, but they said, hey, we've got this $800 medical collection. We know you're not going to be able to close on your mortgage with this collection. That's a lie. But, so we'll make you a deal. We'll settle it for half off. Just pay us $400 and, then you'll be able to close on your home, right? Okay. So she did not call her loan officer. She did not call her realtor. She just paid it. What happened is her score dropped significantly because she renewed the date of last activity. Now it's a paid collection, but like I said, it's a new activity. So she lost the qualification and the property that she was going to be closing on. So we had to kind of work to get that whole trade line removed. And then once we did, we were able to then help her get requalified and find a different property. So just a point of advice there, always ask a question if you're, wondering what's going to happen to the impact of paying a collection. Now, sometimes paying a collection is kind of a chess move that you use to get to where you want to go because a paid collection can be more easily removed through our Fair Credit Reporting Act investigations, right, than an unpaid collection, right, because there's no more skin in the game, right? sometimes even a settled collection can be more easily removed. There are a lot of credit cards, some collection agencies that are very willing to settle with you, the consumer individually. I'm not talking about hiring a debt settlement company that you pay a lot of money to. I mean just you calling up and saying, would you take a 30 cents on the dollar settlement for this debt? And very often you can negotiate some terms there. Then that paid collection, they're not worried about anymore. They're not going to fight any investigations through the Fair Credit Reporting Act that we would do. So that, like I said, is kind of a little chess move there that to eventually get to the end result that we want. It would hurt your credit in the interim until that whole account is removed, and then you'll see a credit score increase. So just to understand about that. Utility collections can be tricky if an underwriter sees that you have unpaid housing collections, if they're looking at the whole big picture, you know, that's your monthly housing payment that you weren't consistent with. That could be a red flag, so you definitely would want to address that. I had a sad story with some utility collections that have popped up on people's credit report. A realtor that called me with a story about her client that had an 800 credit score, got pre-qualified for a property, and then when they went to do their last credit check at closing, a new collection from several years ago from a cable company, unnamed cable company, popped up on her credit report, right? And it was like an equipment return, right? $250 or something. They never billed her for it. They never chased her down for that, didn't ask, and of course she would have paid it had she had gotten a bill for it. But this, client, had worked all of her life to have an 800 credit score, and then that one collection dropped her score over 100 points.
So how did you solve it?
Well, we weren't, they called us for advice, really, like, what happened, what are our options, and we gave them some options. I think she went ahead and closed with the score that she had, and then we're going to work to get it removed and refinance. But just because she wanted to move in, she was like, ready to go. That was really sad. And
How old was
just
that again?
3 years.
And then it just came back and they put it on the board.
Well, I think what happened is they were doing a soft inquiry, and then when it popped up that she had a mortgage pull, then they actually paid to report it, legit, and they were not going to pay to report it if they didn't think that they would, I don't know. It's pretty slimy and sad, right? And didn't give this person the chance to just pay, right? Yeah.
So are you suggesting if there's a old collections that you don't pay those collections?
It depends on what your goals
Because
are.
underwriters will want collections
So-
paid, so you got to catch 22.
Right, absolutely. So any collections that are not medical, right, over a certain amount, the loan officers are going to count a portion of that, and I'll let them talk a little bit more about that probably toward your monthly, obligations, right? So if you have, is it over 2,000? Yeah. So collections over $2,000 are going to be, there's going to count a portion of that toward your debt to income
5%
ratio.
of the balance.
Yeah.
Yeah, which can hurt you pretty hard.
Yes, it could, absolutely. So that's the reason to work to try to negotiate pay. So like I said, it's not that I'm telling you not to pay them, it's just understand the impact of them and the timing on what you're trying to do with your credit. There's no really black and white answer there. But if you're trying to build a house and want to get into, I don't know, whatever your goals are. But if you want some advice or want someone to take a look at that, but I would never stand up here and say, don't pay your collections, because I'm saying understand the impact of when you pay them and what that does to your credit. And if you'd like someone to, like I said, kind of take a look at that, we certainly can do that. So, yeah. Okay. Well, this is a great time to let our loan officers come up and introduce themselves. This is a busy season for them, as you know, it's like a busy season for realtors too, so I appreciate them giving their time to be here today, and this is your opportunity to ask questions, find out more about how Fairway can help you grow your business, and so I'm gonna let them step on up, and I'm gonna step aside.
We didn't know we were gonna do this, so. So do y'all have questions on anything before we, I guess, say some stuff? Anything that she said that maybe that we can help with, or? Questions on her? Oh, sorry, I'm Laura. I'm a loan officer with Fairway Mortgage. We both office out of the Belton office. We're with the Wood Group, Fairway. I'm Lacey. Thank you, Lacey.
You have a beautiful office though. If y'all haven't been by there, go visit them. It's a gorgeous brand new office. Yeah.
We're in the 3-story, the high rise in Belton.
Looking over the street.
Big deal. Yeah, big deal. Yes. Kind of a big deal on three floors. But nothing, I guess, but what she was saying, the one thing is, on those debts on there, we do have to charge or hit you for 5% of the balance. So usually we don't look at the balance. The balance really doesn't matter to us. It's whatever the monthly payment is what matters to us. The balance is what's going to affect their credit score, right? And then we only look at whatever the monthly payment is. So I have a lot of people always come to me and say, well, I've got a really high balance on this or whatever. We don't care really what the balance is for most things, unless it's something that they're not paying. Then obviously we have to hit them for 5% of that balance. But as long as their monthly payment is, keeps their debt to income ratio where we need it to be. But I don't really know what else to say.
I would just throw out that you mentioned CAVERS along with their credit report. So if you're doing a government type loan, FHA, USDA, VA, we're always going to be looking at the CAVERS report as well as the credit report to make sure that you don't have any collections on those government loans as far as student loans, previous VA, FHA or USDA mortgages as well. So that's just as important as a credit report.
We occasionally
What
have
else?
people try to hide things from us, and
Yeah.
it's surprising.
Yeah.
But we always find out about it. So yeah.
You guys doing any down payment assistance programs here?
Yes.
Yeah.
Yes. Yeah. There are quite a few options for that.
Usually minimum credit score is about 620, I
Yes.
think, for the down payment
For
assistance.
GPA.
So FHA is 600. You can do a manual underwrite, but there's a lot of other stuff that comes with that.
What
So
are you guys utilizing to build credit for people who don't have any credit on the active?
I think like Susan was saying, it's important, like she was saying, as far as having a credit card, and if we see that you're, a young borrower and you don't have hardly any credit established, opening that first credit card. As a lender, I recommend the secured credit card. Oftentimes, if they don't have enough credit established to get a new credit card.
How long does it take for when you actually start doing that to where the customer should come back to?
I usually tell them at least give it a couple months. I mean, so we are not credit experts, and we have to say that we are not credit experts. Of course, we know these things just by talking with professionals like her, or just other experiences that we've seen when we're running people's credit. But most of the time I'll say, call me in a couple months, but watch it. A lot of times there's things that they can do to kind of help with themselves, like keeping their balances below 30% of whatever their max is for that credit card, or just making sure that they're not late on any payments. Anybody that's actually going to be reporting to the credit bureaus, opening up a secure credit card. Some of those things are super helpful to bring up, and like she was saying, not paying that old debt, because I always tell people, you're just bringing it back to life. It's there and it's hitting your credit report, but the moment you pay it, if it's something that's super old, you're just bringing it back to life and it's gonna hit it even harder, worse, from what I've seen and heard. But again, I always say, I'm not a credit expert. Yeah, as just a loan officer,
So if you have a 19-year-old that doesn't have any credit, and they don't, and the underwriter, then maybe they build their credit, but they don't have utilization, nor do they have negative,
They have to have a history,
right?
yeah.
So how do you get a person approved that doesn't have any of those?
You really can't unless they have a cosigner. They have to have some sort of history. So even if we pull their credit score and it says it's an 805, and then they have no history, they just opened up 3 credit cards for the first time ever because they're 18, 19, we're not gonna be able to give them a mortgage because they're gonna have some sort of history behind there.
Their dad added them onto 3 credit cards,
Yeah,
you know,
to
and
help them
obviously,
with their
right,
score.
the credit cards have been open longer than the kid's been alive.
Yeah.
Right, like, probably didn't get that on your own, right?
No, no. So they could probably go out and get a credit card easily and possibly even go get a car. But for a mortgage, no. They're gonna have some sort of history
Well,
in their name.
I've actually, my son tried to get a car loan at Excel here in town, and they couldn't get a car loan because they didn't have car credit.
Oh, interesting. So new. So I guess maybe with the credit, maybe it is the same with, yeah. So he'll have to just build some things and have a history on there and not necessarily just be like added onto your credit cards. He'll maybe get his own and then continue to kind of build that history.
How old do you have to be to get credit?
I don't know.
18?
Maybe?
18?
How old do you have
Used
to
to be
be?
younger than that.
Yeah.
And in order to move,
I mean, I could put my 8-year-old nephew on a, you know, credit card probably, you know, right? But
Yeah.
not that he's gonna need. But yeah.
So 18 to 21-year-olds can't really get a home loan?
We do home loans for quite a few younger people. And I don't know, I guess I've never.
It probably
truly
depends
been-
on how much money you're putting down, probably, but wouldn't you say that could
FHA.
affect that, you know?
FHA.
With the FHA loan, the 18-year-old getting an FHA loan?
I mean, if they have the history, they just have to have the history. I don't know, I guess I've never done an 18-year-old, but I just closed a 20-year-old married couple, and it was, you know, perfectly fine. But they had, you know, 2 years of history of paying credit cards and doing something else, and
Jobs.
made me feel like a horrible person, because I sure was by a house of money.
Yeah, right. And other priorities at that time.
Yeah. So, but we always say, I mean, of course, always just come to your loan officer. We're always here to help you. If there's questions that we can't ask, then we'll toss you along with someone else that can. But we're always happy to help if you guys have questions or if your borrowers have questions about certain things. We don't mind at all. I would just say, give everybody my phone number, have a phone,
Yeah.
or text me.
Yeah, absolutely. That's why having some, you know, loan officers that you can trust and pick up the phone and say, hey, what do I do? Or could you take a look at this? And they'll definitely, you know, try to do that and help you guys.
They're always looking.
So how long, when you're saying like don't touch collection sometimes, how long does it usually stay on? Is it 7 years till they fall off?
Negative reporting is 7 years, yes.
Off everything?
Negative reporting.
Okay.
And can't they sell it?
Yes.
And then somebody can re-hit your credit report even if it's been 7 years?
And then it starts back over?
Yes.
Yeah.
Yes.
So and a lot of times they'll do that, sell it, and then it'll be on your credit report forever.
Also on student loans, what about people having like a forbearance or that income-driven payment and all that? How does
So,
that work?
If you look, when we see a credit report, it'll say in the details that it is in forbearance or, you know, deferred, you know. So if it doesn't have any negative impact, it looks like it's just being, you know, kept up as agreed.
And it doesn't count as like a monthly payment?
It does.
It does.
You do have to hit your
Yes.
DTI.
Okay, even if you're in forbearance
Yep.
or something? Okay.
Even if you're not making payment, it's usually 1%. I think there's something new maybe with conventional that I've heard where
Has to be
possibly it can be like
amortized over 20
half
years.
a percent or something. Well, we have to make sure that it amortizes, yeah, but
And for certain loan types,
I
you
haven't
were
done that
saying
yet, but-
the income-based repayment, oftentimes we can't use that. We have to still use the greater of whatever that payment is or 1%. And if we can see that the payment that's reporting on the credit report, if it's $20 and it's a $20,000 balance, then we know that, you know, that's obviously not going to fully amortize or be paid off in a number of months that it's reporting. So we know that their payment's going to increase
at some point in time. So we just didn't have to get documentation for that, and, you know, make another day or use, you know, the 1% rule. Yeah. Yeah.
Who does your rapid rescores? Do you guys do the rapid rescore, just like a company like Trinity does?
We don't.
We send them off to factual data, which is where we pull, the factual data pulls from all three of the credit agencies. And then when we're doing a credit rescore, if we're working with somebody who needs to have a higher credit score, whether they're just looking for a better interest rate, or they need to get to that minimum level of either 600 or 620, we'll send it off to factual data. And then sometimes it's just one or two specific agencies that they'll send it to try to get it to go up, depending on which score needs to go up. And then we actually pay for that service ourselves, and then they have to do, of course, whatever it is to bring it up, whatever it suggests.
Say you have a question for you. If you have 2 bureaus that have credit on there and one doesn't, how can you get that third one to have that credit?
So in that case, they don't have enough information. I've seen a credit report like that where they're, you know, like TransUnion and Equifax had a score, but Experian didn't have a score. So whatever trade lines that client had weren't reporting to Experian for whatever reason.
Right.
So in that case, I would recommend something that we know would report to all three to create some data that.
We can do a mortgage with 2 scores. If only 2 pull in and the other one's not reporting, we can do a mortgage if there's just 2 scores. Now, if one of them is locked and they've frozen the other one, they have to unfreeze it.
Well,
We have to make sure
speaking of
that
a
they're
line
not.
though, so if I had a Wells Fargo as an example as a creditor, it's only reporting on the 2 bureaus, but not the third one. How do you get that third bureau to pull in that Wells Fargo?
Oh.
You have
It
to
may not be
contact-
the bureau's fault. It may be
No,
Wells
it's-
Fargo
Yeah.
not choosing to report to all three. Or I don't want to talk, I don't know if it is Wells Fargo, but whatever that creditor might not choose not to report to all three.
Huh.
Yeah, it's whoever they're reporting to. And I mean, sometimes it just doesn't matter anyway. We don't really know.
Yeah, yeah. It's one of those case-by-case basis types of things, and what's the big picture? And let the loan
Well,
officer.
I've seen
you know,
credit reports where, I mean, it's 40 to 50 points difference, and because that one is not reporting on
Yeah.
there, I mean, that's a big difference, 40
Yeah.
points,
Yeah,
you know? And they're not reporting it for that 1 year.
I know,
yeah,
we see it all the time.
yeah.
We've seen 100-point range. Yeah, you know, and that's why in mortgages, they use that middle score to kind of work with the average there. Good questions, you guys. I hope that you found something that you can learn, that you learned that you could use in your business that will help the client. You know, I'm certainly here to be a resource for you. In fact, I'm doing one this week. I do some meet and greets with clients. So if you're ever wanting to get a group of potential buyers together and bring in some experts to talk about loans and credit. I've done some home buyer seminars, home buyers workshops, just informal, you know, pizza party or a wine and cheese, whatever you want to do, that kind of thing. But I'm happy to be a resource for you. If you have questions about our program, you know, obviously, you know, you might have some, you know, questions about how that works. You know, the class today was not to teach you about my company, you know, so, but if you want to contact me, text me, email me, I'm happy to tell you a little bit. We've got 3 different programs that we can help people with. It start as low as $70 monthly, so it's a good reason to ask. So, yeah.
I'm gonna say you get an A+ from me.
All right, I love it. Well, I'm gonna let Tracy come up. She's got a couple of door prizes she's earned for, and I've got one too. And then we're gonna get you out of here because I know you guys are busy.
So just from the River Fairway, we do have 2, but I'm gonna have Miss Amber draw them since she's the impartial party here.
And I promise my eyes are closed.
Eyes are closed. Alright, so this one we have Linda Mathis. Alright. You're very welcome. And next up, drum roll. What's your first name? Mr.
That's why you
Walton?
got an A plus.
Mrs.
Barry.
She was good.
Very.
Yay! Thank you guys for coming, and I hope you have a great day and got some great information.
Thank you. Good class.
Sweet. Thank you, Megan. That's so great.
My wife's got like 15 years. She has all colors and stuff. I got one. 15.